Our market fundamentals are really important to give us a little bit of optimism about multifamily in our local area. I don't keep tabs on other areas, but I know it's very different than Portland. It's very different than some of the other regional markets that are overbuilt. We had very low single family construction over the last decade compared to the prior decade, and very high multifamily construction. Particularly the last couple of years, our deliveries have outpaced what the annual demand would be for new units in our area. So often I see folks list properties. They might even know in advance that the roof needs to be replaced or that there's substantial damage to the siding and it's peeling paint. And maybe that's their motivation. They don't have any money to bring to the table and they just want it gone. It feels like we're at a tipping point into value decline. And it feels like we really hit a peak in 2022. We've been coasting and now we're like headed down. We spend a lot of time talking to brokers. I'm talking to you all the time, interviewing other brokers because you guys are on the ground. You're getting real-time feedback on your listings.
Hey everyone, and welcome to another episode of Commercial Connections, Investing with Confidence. I'm Brittany, the producer of the show, and today we have an incredible guest, Zoe Swartz, with us. Zoe is a powerhouse in the world of real estate appraisal, bringing a sharp analytical approach and years of experience to the table. She's not just an appraiser. She's a business owner, a problem solver, and an expert in valuing complex properties. And now I'm going to read a little bit about her bio. After earning her BS in Applied Mathematics from the University of Oregon in 2008, Zoe began her career at Duncan and Brown Real Estate Analysts. In 2021, she co-founded Viewpoint Appraisals, specializing in appraisals, appraisal review, and consulting across Lane County. She's been a designated member of the Appraisal Institution since 2014, and she's an expert in multifamily properties, developmental land, subdivisions, and special purpose properties. Leading today's conversation is your host, Rene Nelson, an award-winning CCIM in the Eugene, Oregon area, helping investors grow and refine their portfolios. Before we dive in, we just want to welcome you, Zoe. Thank you for coming on.
Yeah, thank you for having me. I'm really excited.
Okay, first, before we start with anything, you have to tell the audience what your prestigious award was that you won. 20 under 40. Is that I never get the name right. 20 under 40?
Yeah, the 20 under 40 award this year. Thanks to my good friend Rene, who nominated me, helped nominate me.
That's so cool.
So tell the audience what it is, because people may not know.
20 business professionals in our local community get recognized each year, 20 people under 40 who are recognized for not just their business excellence, but also service within the community. So basically providing both leadership in the service to our community and within our respective professions. So it was really exciting, and it was humbling to be on the stage, when we had the award ceremony, to hear what everybody else has contributed. A little bit of imposter syndrome, but it was really an honor and kind of fun to be one of the recognized people this year or last year.
Well, Zoe also gave a short bio. I know that she's been instrumental and dedicated in sharing her time with lots of community charities in our area. Sponsors was one of them. Are you still on the sponsors board?
I just left the sponsors board last year, but I'm still on their housing committee for obvious reasons. I have something to contribute still in that arena.
That's awesome. Share with the audience what Sponsors is.
Sponsors is a organization, a nonprofit that helps with reentry of folks when they come out of prison. One of the things that they're doing is they help find housing, supportive services, and just help the post-prison population reenter our community and become productive members of society. And it's something very near and dear to my heart because, one mistake, two mistakes shouldn't make a person. And a lot of times just going back into the exact same community just increases recidivism, and it costs us more money and it creates more crime. And if we can help people reenter into safe and supportive environments, then they aren't reoffending and they're able to become tax-paying, hardworking citizens. And the success rate is really amazing at Sponsors.
It keeps a lot of people off the streets and, like Zoe said, from reoffending and going back into prison or jail and stuff. So thanks for everything that just the time, Zoe. I know that you were on that board before you even had your child, and now your child's 4. And I mean, you've really dedicated a big part of your working career to giving back to the community. So thank you for that. It's pretty cool.
That.
That's incredible. Yeah, that's amazing work. I think that's so important too, like in helping build up the community. Yeah.
Yeah. All right. For our listeners, buckle up, Buttercup, because we are about ready to talk about multifamily housing in Eugene-Springfield, commercial a little bit, and student housing. That is Zoe's sweet spot. You are going to have the privilege and the opportunity to hear the smartest person that I know about trends and cap rates and reading the tea leaves. So first, I guess I'd like to ask you, Zoe, when you get a call, because I know you also do a lot of estate work for attorneys and people that are getting divorces who have to establish values. Walk us through when somebody calls you and says, hey, I need an appraisal. What do you look at for a multifamily property?
So, well, the first thing that we do in the appraisal world is chat with them a little bit about the intended use, scope of work, intended users. Intended use and intended users drive the appraisal process completely and drive that scope of work. And so having an understanding of what it is that they need, what they need it for, will dictate how the report is structured. The appraisal process itself is identical no matter how the report is structured, all the things that we go through each stage. But once we've discussed scope of work and we start moving on to the appraisal process, the first thing that I ask for is probably really similar. I've listened to some of your earlier podcasts of what a broker would ask for or an investor would ask for. I ask for 3 years profit and loss history, current rent roll. I ask when they last increased rents. And I want the current rent roll to show when they last increased rents and also initial date of tenancy and when the lease goes through. And more importantly, nowadays, in the last few years, I will ask for, give me your most recent insurance premium and history on any insurance claims on the property. So those are the things that I ask for initially. And then, of course, I ask to inspect the property, see a couple of units of each type and condition. And then we go from there. But the primary things that I'm looking for a multifamily, for an investment income producing property, is that profit and loss and rent information.
Okay. And what are some of the things that you look at in a profit and loss statement? Because I know it's a little different on a cash flow statement that you may get from a property manager versus, say, a tax return. And for those savvy investors, a lot of times that's a Form 8825 if you own the property in an LLC. So walk us through, when you're looking at a tax return, are there certain expenses that you kind of throw out or don't use? How do you drive to the bottom line for your analysis?
So I certainly prefer a management company profit and loss because that is going to be the most detailed. It's going to itemize the way that I would typically look at things, so I can actually break out and see, rather than just one big blanket other category, I can see, oh, that's trash, oh, that's internet, that type of stuff. When it's a Schedule E or another tax return, that one can be pretty tough. I usually end up having to ask a lot of questions to the owner about what those expenses entail. A lot of times I see like trash expense get thrown into other rather than in utilities. And a lot of times on these tax returns, there's the other category and it's $50,000 of other, and it'll say C form, the supplemental form or addendum, and I'm not provided with that. So I have to ask for that. And that's something to consider if you are providing tax returns, to also provide the statement that explains what the miscellaneous and other expenses are. The other thing about tax returns versus profit and loss is things get lumped into the tax returns that may not be ordinary expenses. You have, especially in the other category, but you have maintenance and repairs, and we've seen on tax returns, there might be car rentals for the owner or their, personal management. They might have their phone expense lumped in there. So you have to be really careful to differentiate between ordinary market-based expenses and operational expenses for that owner. And so a tax return will result in a lot more questions from me, from the owner, But usually just looking at a expense statement, the expenses that are very standard that I will carry forward usually without question for a property would be property taxes. I mean, that I can get from the county, but that's going to be consistent and 3% increases. Insurance, but again, I'm not looking back anymore. I want that premium for right now. And then utilities, because utilities are very property specific. They're usually very consistent and they have a lot of consistency in the market, but there's just very slight variability between properties based on their physical characteristics. So using utility expenses from the actual property is the most reliable. Then when you get into maintenance, turnover, and management, that's where I start taking a really close look and asking a lot of questions. And a lot of times, especially for owner managed projects, I end up using market standards.
And why do you use market standards versus what's on the property manager's cash flow statement?
Usually it's because inconsistency, 3 years actually isn't that long to look back on a statement. And particularly for owner managed projects, you can really see huge variations, not only in the way they categorize things, but one year they might have zero expenses and the next year they might categorize roof replacement as in a maintenance expense or something that might be considered more capital expense. When I get a management profit and loss statement, and if I have enough running years, I will use those because those are very consistent. It's professionally managed. They're making updates and doing repairs on a schedule. And usually there's consistency there. I might see 650 a unit, 850 a unit, 750 a unit, over a 3-year period on a maintenance expense, which really averages out to a pretty consistent average over that 3 years. Whereas with an owner managed project, you might see zero expense, 4,000 a unit, 200 a unit. It just can go all over the board. And that doesn't really provide a consistent historic expense to use for projections. And so it just is a matter of how much consistency there is. And if I can see major gaps in the maintenance that's been done, then that's not a reasonable projection going forward.
Okay, that makes sense. What are you seeing right now for cap rates in the Eugene-Springfield area for multifamily, non-campus, just market rate, multifamily in general?
So one of the biggest issues with data right now is that we had a huge surge of transactions and acquisitions up through 2022 when rates were really good. And when interest rates increased, the transaction volume just tanked. I mean, we're still seeing things happening. You're selling stuff, you still have people interested in buying, but the number of transactions is so significantly reduced that it doesn't provide for a very statistically significant data set, especially amongst income properties. When you're talking about income properties, you might have several physically comparable properties, but they are so vastly different in risk characteristics that you're not comparing apples to apples. So an example of that would be we've had maybe 5 or 6 sales that have happened in 2024. A couple of them had rents at market and they were renovated, and those cap rates tended to be in the 6.3% range. Whereas we had one project that was rented 30% below market. That was a 4.2% rate. And then we've had a couple that are, 10, 15, 20% below market, even 25% below market. And those have transacted, in the 5.6 to 5.9% range. And so 4.2 all the way up to 6.3 on very similar asset classes. We're talking same construction, original construction date, project sizes, some variation in renovations, but most of the variation has been whether the rents are at market or not. So it becomes exceedingly important in a market like this where you don't have sales to take a really hard look at the specific risk characteristics of the income and the expenses of the property that you're working on.
When you're talking about cap rates, it's interesting because from a broker's perspective, I'm looking forward and I'm trying to decide what is a buyer willing to pay for this property. And then I have to weigh in what's it going to cost them interest rate wise or capital wise when they have to go get a loan, because not everybody pays cash. There's lots of cash out there, but a lot of investors, especially if they're doing a 1031 exchange, they need a loan. And so it's such a interesting, I spend a lot of time just staring at numbers, just analyzing it, combing it over and over, thinking, can I hit that number? Can I hit that number? Because the last thing I want to do is take a property to the market, overprice it, and then it sits there and I don't get an offer. And, then it's just like in residential. Then people wonder, was there something wrong with the property? Did they have an offer and it fell through? What's wrong? So I know that you have a tendency to look backwards because you're looking at the sales that have occurred. What's your kind of crystal ball for cap rates? Where do you think we're going to see in 2025 and going forward?
So I would say that with my limited data set, I have been able to sort of interpolate a cap rate increase over the last year or two. From 2023 to 2024, we had maybe a 50 to 100% basis point cap rate increase, but it wasn't property wide. That's just kind of a general statement. Things that maybe would have traded at a 5% rate are now hovering more around 6. But there's so much inconsistency in the market. It's just not a uniform market. That is a very general statement, 50 to 100 basis points. But the challenge moving forward, like you said, I'm subject to looking at data in the rearview mirror. And sometimes that rearview mirror is a lot farther away than I want it to be. And in fact, particularly for appraisals, when there's not a lot of market data, we spend a lot of time talking to brokers. I'm talking to you all the time, interviewing other brokers in the particular property asset class that we're working in, because you guys are on the ground. You're getting real-time feedback on your listings and from your buyers and seller side on buyer and seller motivations. Whereas we're a little bit hamstringed by looking back at the data. And while we can make projections, we still have to have a credible and supported appraisal report. So sometimes we might have a general market sentiment of moving up or moving down, but we are having to stay rooted in what the data tells us. And so sometimes appraisals can lag in real time. And that's why it's super important to have your finger on the pulse of the active listings and what the brokers are seeing. I would say the biggest challenge moving forward is that we expected rates to go up more than they did over the last few years. I think we all did, brokers and appraisers alike, and investors. And they really didn't have the upward movement that we were expecting when a lot of these projects don't cash flow at current rates. So you would have expected the rates to go up more. But what a lot of folks are referring to is there's just a disconnect between buyers and sellers right now. And there are still transactions happening, but sometimes that's a cash buyer or a 1031 exchange or a motivated seller. And there just aren't enough transactions to truly trend what's happening in the market. There's just still this gap between expectations. Your question was, what's my anticipation? In general, for the market, it seems like the trend will be stability for 2025. That being said, there's a lot of micro and macroeconomic conditions that could dramatically change that. And there's also, if rates change substantially, which they're not expected to, but that could change the environment. We're expecting stability. And that's largely because in the environment where rates went up and transaction volume went down, we did not see the type of movement that we expected. And that either means the market has been exceptionally slow to adjust, or we are a little bit more sheltered from those types of fluctuations because of the supply and demand fundamentals and the demand for multifamily in our area.
You mentioned about interest rates. What effect do you think that will have on multifamily sales going forward also? And let's pin it down to renovations. Let me start there because in the past, we'd see investors come in where it was below market rents. They were willing to buy at a low cap rate, knowing that they were going to renovate. But I'm starting to see a transition with that where the buyers are saying, no, I'm not going to pay that seller a 5 or a 5.25 cap rate because there's too much risk and exposure for me. I may not be able to get it converted fast enough and get it renovated. I know you appraise a lot of different properties. What are you seeing?
I think you're right on the money about what's been happening with these upside projects and just with projects in general, and why this market sentiment is kind of this disconnect between buyer and seller. Because what was happening a few years ago, just in the broader picture, is that market rents were going up significantly year after year. And also our vacancy was exceptionally low, meaning there was an undersupply of units in the market. And so if you were looking at investing in a project with below market rents, let's say it was 20 or 30% below market rent, you're not only looking at the upside of what if I just slowly increase rents at the maximum 10% per year. That's significantly higher than market growth, compared to other projects that are just at market rents and sustaining market growth. You're going to get that 10% a year, but also you can renovate and then substantially bump the rents. And there was just so much demand because we had such low vacancy that there wasn't as much risk. And then on top of that, the interest rates were favorable enough to make the acquisition cash flow at these low rents and then make the construction feasible. Now we're at a turning point. We're in a completely different climate where we're really at equilibrium in the market right now. Our vacancy is right around 5%. We've seen rent growth taper down to 0% in some places. Some of the newer stuff has seen a little bit of a decline, but on average we're somewhere in the 1% to 2% per year range, which is below historic averages. And so all of a sudden that upside that you got not only from rent increases but also from market increases, it's diminished substantially. And so those low cap rates, I think, stayed down during the time when rates were going up, because the market was still in that favorable undersupply position. And you could justify a low equity return on your initial investment because there was such huge upside. And so that kept the cap rates low, even though the interest rates were high. That's a whole another conversation, kind of a band of investment approach. But effectively, if an investor is willing to take a slightly lower return on their end, then the interest rate, the cost of money, can be higher because they're willing to take a lower return. Whereas if the return they're requiring stays level and interest rates go up, cap rates have to go up because the sea floats all boats. But I think that what's happened is now the equity returns, the investors are saying, we're in an equilibrium market. There's so much more supply. If I renovate these old units, there's too much competition amongst new units. I might have extended vacancy. I might have more turnover if I post rent increases. There's just more supply out there for folks. And so the ability to take a low equity return and pay that low cap rate has really been diminished. And so, like you said, Rene, I think some of these ones that have been sold recently at 5.8%, 5.9% cap rate, they would have been 5% cap rates, 2 years ago. And so the interest rates effectively did not impact things at first because the market was so strong and equity returns were lower. And now I think if they stay where they're at, we're going to have to bridge that gap between buyer and seller. One of the things that I talk about, though, is that if rent growth returns to more normalized with the historic average, our multifamily properties can sustain a little bit of a cap rate rise because rent growth rises, the NOI rises, and if the cap rates come up a little bit, you stay stable, your values stay stable. The problem we'll be in is if rents stay low and cap rates go up a little bit, and let's say insurance skyrockets, now you're looking at decreased NOI, elevated cap rates, and all of a sudden your values start going down. So we do have a little bit of risk of that. And you and I may want to talk a little bit about market fundamentals and where I see us going, because I think that's a big part of the picture. But right now we're just at this tipping point where we're at equilibrium. Investors are kind of being headstrong about not wanting to take these low equity returns. And we're all just kind of sitting here waiting for the transactions to happen, because as analysts, we can't prove up on anything until the sales happen. And it can't just be 2 or 3 sales. It has to be a significant enough data set that you actually have apples to compare to apples, not oranges to bananas.
Yeah. Let's talk
about what I'm comparing right now.
Let's talk about market fundamentals, but let me also kind of share a current example. I have a 20-unit property listed that's walkable to the University of Oregon, and the seller and I look at it every year for the last 4 years, and he's really pushed me. He wants a certain price point, and I keep saying, I cannot hit your price. That's higher than what the market will demand. Finally, we came to an agreeable price, and I knew that I was pushing the cap rate. I think that cap rate that I have it listed at is like a 5.3 cap, and the units have not been renovated. So the seller sees that as the meat on the bone or the motivation to an investor. Hey, you could come in and buy this, renovate it, and increase the rents. My property, the listing is at like $130,000 a unit. And again, I've got 20 units listed, 30 units just came out on the market at 64,000 a unit. And I have nothing but crickets right now on my phone. So it just proves how one competing property could come into the market at a little higher of a cap rate. So Brittany, just so you know, the higher the cap rate, the lower the sales price. Cap rate and sales price are inverse with each other. So, if you have somebody that comes in with a little higher of a cap rate, it could really impact you if you're planning to go to the market and you want to sell your property. And I think I would love to have you talk about market fundamentals, Zoe, but I think one thing that you and I see a lot in our market is where the owner of the property, especially if they've owned it for a number of years, they've kind of elevated and lifted that property as high as they can with market rents and, like putting down vinyl, but they don't want to go in and do a full renovation where it's, 20, 30, 40,000 a unit, because that takes skill. And that takes somebody like, we know several investors in our market share that do that for a profession and they make great money at it, but they're also really smart and they know how to do it. If you own a property and you're out of town, you're probably not going to want to try to do a 20 unit renovation. So with that, talk a little bit about market fundamentals and what you're seeing.
The only reason I want to stage the middle of our discussion with market fundamentals is that I think we're in this position right now where things feel a little dire. It feels like we're at a tipping point into value decline. And it feels like we really hit a peak in 2022 and we've been coasting and now we're like headed down. And I think that our market fundamentals are really important to give us a little bit of optimism about multifamily in our local area, because it's very different than, I don't keep tabs on other areas, but I know it's very different than Portland. It's very different than some of the other regional markets that are overbuilt. And what we've had happen over the last few years, I'm going to try to make this really short because this isn't a market fundamentals talk, but we had very low single family construction over the last decade compared to the prior decade. And we had very high multifamily construction. And particularly the last couple of years, our deliveries have outpaced what the annual demand would be for new units in our area. But when you look at the decade as a whole and the contribution of single family versus multifamily construction, and the fact that interest rates, while they kind of crush deals for sales, interest rates also crush new construction. You can't make new construction pencil. And so even though we've had these really high deliveries in 2022, 23, and 24, and there's still a reasonable pipeline in 2025 because these projects were already underway several years ago, the construction pipeline is dropping out substantially compared to these peak years that we've had. And assuming that we don't have a significant population decline, we are at equilibrium now with all these recent deliveries, maybe teetering a little on oversupply in the short term because they all came online at once. But our vacancy suggests we're at equilibrium, which means that if our construction pipeline drops below projected need year after year, we will tip back to undersupply in a pretty short order. And these interest rates in the current economy, construction costs, availability of land in our area specifically is going to cause that. It's not a particularly easy place to build. We have an established urban growth boundary. Construction costs are high, interest rates are high, projects are being put on hold that were originally going to move forward. And so in that landscape, we are kind of in this tipping point right now, but unlike areas that might be at 8, 10, 12% vacancy, that takes years to recover from. We are at equilibrium, meaning we were undersupplied up until very recently. And so at equilibrium, a couple years of low construction, and we're going to be back in the game with rent growth and lower vacancies. And so I think our local market should be a little bit more sheltered than some of the bigger markets. We are going to have to weather this short-term storm in terms of lower transaction volume, developers not willing to take low equity returns, still some oversupply in some submarkets, but within the couple year projection period, we're really sitting pretty well locally.
And what are you seeing also for the university with student housing development? I know the university has talked about they may start to do some development on the east side of campus for housing. How do you think that'll impact the national student housing developers that want to come in and build in our area?
So don't quote me on this because I haven't stayed completely on top of it. But last I saw their, 20-year plan was about 3,500 beds, something around there. And the short term plan, which is really like 2027 and 2028 was 800 beds, which is a lot. Although translating to units, if you're talking 2-3 bedroom, it's 350 units or something equivalent, because I tend to talk in units just to keep it across the board in the broader market. And that's not going to happen for a few years. I don't think that's going to be, I think it's going to be something to keep an eye on, especially if you're a developer looking at the specific university population, and also considering that a good portion of the new development in the last year or so has been campus specific and catering to students. And so 350-ish units per year in a couple of years, I don't see that being a huge impact. And I think it's going to take them a while to really materialize the rest of their plans. And so just based on their initial delivery schedule of out of their total project doing 800 beds in one year and 800 beds the next, I'm not sure that's going to have some life-changing impact on our overall supply, especially given that that's going to be coming out of some low construction years or anticipated lower construction years.
And what are some of the big risks for investors that are looking to get into the student housing market? Not the big institutional people, but somebody that wants to maybe come in and buy a 10-unit apartment complex or 20 units. I have one listed. Oh, did I mention that? Never mind. But seriously, an investor that wants to get into student housing, as an example, what are some of the risks in your opinion at this point?
So I do a campus survey every year, specifically, which you've helped me with in the past, and it's specific to only campus managers and campus projects. And interestingly enough, up until this year, we didn't have an increase in campus-wide vacancy. This year, we saw a pretty substantial increase in vacancy, but it was almost exclusively in those institutional projects. And that we exclude stabilization projects and stabilization, so that doesn't count projects that were recently completed that were 50% occupied. But once a project's stabilized, the institutional grade apartments have higher vacancy this year for the first time in a long time. But the general market, when you're talking about smaller, I don't even want to say 1960s, 70s construction, because there's also things 2010, 15, 20, but just the smaller non-institutional grade type of product, those are still doing really well in terms of occupancy despite the new construction. The rent growth has slowed this year compared to prior years. The pre-leasing season is less intense. It used to be just pre-leased immediately within a couple of months, and it's trailing off a little longer than usual, but it's still got a pretty high occupancy. And so there's not a lot of danger within that sub-asset class. I don't appraise the institutional stuff, so I don't have the insider knowledge of that. And that's a very specific submarket. And it will impact the larger market, because if there's tons of availability and they have to drop prices, then all of a sudden you're sucking students out of other housing. But it is a very particular product type. And the vacancy seems to be, secluded to that type of apartment right now. And we've still seen moderate rent growth within these smaller projects. So when you ask about risk, I think the higher risk that I've seen in terms of income volatility has been the projects that were built. It's funny because I was thinking about this the other day, and I was like, oh, the projects that were built 10 years ago, in 2000. No. So projects that were built 2005. So when construction really started picking up on campus in 2007, 2008, and the initial projects that were built are a very different product type than is being built today. Not only in terms of luxury and layout and in-unit laundry, but it's just, everything evolves. And the product being provided to students these days is a lot more luxurious than it was in 07, 08, a lot more luxurious than it was when I went to college. They're very nice units, and they have in-unit laundry, and they have expansive living areas and granite countertops, all those things. And I think the biggest challenge I see is when you have 15, 20-year-old projects that have been getting really solid rents, they can't compete with the new stuff without major overhauls. And so there's more of a risk within that particular construction era, because you are trying to compete with the newer construction. And also you're going to start seeing major building component replacements at that age. You're no longer competing with the brand new stuff. And so there's just more income volatility risk to that particular asset. The 1960s, 1970s stuff seems to do really well. And with moderate renovations, they can increase rents pretty substantially. Some developers retrofit in unit laundry if they're configured in that manner, and they can get, good rents out of that. And then the newer construction stuff seems to be doing pretty well, even in light of competition with the bigger projects. Income and expense volatility are what make up risk, right? So then you've got income and volatility there and expense volatility in that particular subclass.
I just talked to a student housing developer that I've helped over the last couple of years. They're a private company, buy a lot of student housing projects, and they've renovated them. And they were mentioning that putting a stacking washer dryer in a utility closet closest to the kitchen, that hands down has helped them with those 1960s and 70 two-story walk-up campus properties near the university, because the students will pay $25 extra and they're the first to fill on their list of available if they've got laundry in the units. So it is interesting how that can, just that little difference, if you can figure out how to get the plumbing to work, it can make night and day difference for pre-leasing and your lease rates and everything else.
Yeah, it's just become an expected amenity, I think. And so it's a new baseline. And to be competitive in the market, that gives you an edge.
Yeah. Think about, Zoe, when they started to build the bigger stuff and they started building those 4 and 5 bedroom units because they were going for maximum bedrooms, but they didn't have big amenity packages. Boy, I would hate to own one of those institutional type properties, because that 5th bedroom, as you and I have talked about, that's always hard to find 4 people that that could afford that higher rent, or even a 5th roommate. So do you see where property managers are still locking off like the 5th bedroom and just renting 4? I haven't seen that much in the last couple of years.
I don't see that much. Sometimes if you get to the end of the pre-leasing season and they really just, it might be 1 unit out of the manager's whole portfolio gets a bedroom locked off. But what's been super interesting to me about these large units is I think the big apartment units, the 4 and 5 bedroom apartment units, they were really stacking the bedrooms in. So it was like these townhouses where it was just bedroom, bedroom, bedroom. And like you said, not a lot of amenities, and they were all stacked with one another. It's really kind of fluctuated year over year, the demand for those, but they just aren't as high demand as they once were because there's so many more bedroom options out there. They were real money makers when there was such an undersupply that kids just wanted to pile in for cheap per bedroom. Mm-hmm. Interestingly enough, though, there's quite a few large houses out there. Some are like new construction, some are renovated, some are even older construction that have 6, 7, 8, 9 bedrooms, because that's legal now. There's not an occupancy limit of unrelated persons in the city anymore. And so you can rent to 10 unrelated people in a 10 bedroom house. And those are in very high demand. They've seen, based on what I've seen over the last 3 years, in a climate where rents have really very, very moderately increased market wide and on campus, I've seen 5 to 10% rent increases every year on these big houses. And they're not just houses, they're, houses, duplex, but the key is they're very big. They're mostly private because they have single family or duplex configuration, and they have amenities. They have a lot of living space. They have in-unit laundry. They have a little bit of parking, and they have the privacy, the big party porch, right? Or party balcony. So, and that's different from those units, the 4 and 5 bedroom units that were really packed in there and just didn't have that house, big privacy feel. But that's been a really interesting revelation looking at these big rentals in the market, because you would expect the opposite trend, especially in light of this lower demand for the 4 and 5 bedroom apartments. But these bigger houses have done very well the last few years.
Yeah, that's interesting. If it's new construction for those bigger projects, the houses and the kind of the duplex style, I think we're seeing where they're actually putting a bathroom in each bedroom, right? And I've heard that they're pulling like $1,000 a bedroom for rents.
Yeah, that's kind of the evolving amenities, right? Bathroom per bedroom, lots of high-end finishes, privacy. And now we're seeing less parking because the city isn't requiring parking. And they're even able to function, even though you're packing 10 kids in there, they're able to function with less parking because there's street parking or they're walking. But it's been very interesting to see how these have transitioned, especially in light of a lot of the competition being big apartments with one bedroom and one bathroom, functioning in that same almost like quad. It's almost like a quad, right? Or, quint gets up to the 10, but they're functioning the same as these institutional grade projects in terms of the bedroom, bathroom, and even the luxury. But the privacy, I think, is what gets it for the kids because they're not in an apartment and they have their own house or their own, duplex. And that's been a big rent growth sector.
Yeah. I'd love to have our favorite property manager friend who specializes in campus. She's super shy, and I've asked her multiple times if she'd come on the podcast, and she's always like, no, that's not really what I want to do. But I would just be so curious to hear from like her perspective. Are they still doing roommate matching? And, I've heard that most of the property managers have now gone to just one master lease because, doing individual leases was just a nightmare. Could you imagine managing 10 tenants on one side of a duplex? That'd just be crazy.
No, and I can't. And then having to match, if one moves out, having to match one person within a group of unrelated 10. I mean, I can see that would be awful. But having regular conversations with the managers is just gold because similar to talking to you about what you're seeing on the ground, day in and day out about what are your sellers saying? What are your buyers saying? What's your biggest deal killer? Understanding that from the management perspective is also extremely enlightening because they are talking to the tenants. They know, do they care that there's a second laundry room? Do they care that there's a second fridge or a third fridge? Do they care that this is basement living versus above ground? I mean, they know all that stuff in a way that it's not evident in the data. You can quantify some things, but there's a lot about, especially rental data, that you just can't extract adjustments. It's about talking to the managers and understanding what the demand is. And so they have the best insights.
Yeah.
And having a good manager is huge.
Yeah. Oh, that is so true. I see that all the time. I always find it interesting when somebody self-manages and they want to give me their expenses on a yellow line piece of paper. It's like, no, we need something a little more efficient than that. So, yeah. Let's talk about multifamily and how to optimize that if someone's interested in selling, because I think there are a lot of people, as we've talked about, they've owned their multifamily properties for years and they've lifted them as high as they can. You've talked a little bit about rent growth, but I know a lot of people are just thinking they're in the fourth quarter of life, as an example, and they're thinking it's probably the right time for me to do something. So if the seller is looking to transition their multifamily property in Eugene-Springfield, what are some steps that they should consider in getting their property ready for sale?
Get a good broker.
Well, and I was looking more from your perspective, like how do they get the highest appraisal value?
So I joke with you because it's like for marketability, you're the guru. You're going to give them the best advice because, like I said, you're the one hearing the buyers saying, I don't like the way that looks, or, this is a real sticking point for me. From a valuation standpoint, what I see the most of is if you haven't increased your rents in a long time, increase them, get them posted, get them increased before you get an appraisal or go to market. And the reason for that being that even if you're able to increase rents 10%, say, and I will look at that when I'm doing an appraisal, if you haven't done it yet, I don't know if you're going to have turnover. I don't know if that 25-year-old tenant is going to leave and you're going to have to redo that whole unit. There's just a lot of risk with just pie in the sky potential for increases. Whereas if you just post the increases if you're well below market, you're likely not going to have a lot of turnover because the substitute properties that are affordable are very limited, especially if you're very below market, or maybe if you're closer to market, you might have 4 or 5 turnovers, which is a risk. But usually if you do a modest rent increase before you go to list or before you get your property appraised, that is realized rent growth. And I will analyze that income number versus the lower income number. And now that new income is not projected, it's not higher risk, it's actually realized and achieved rent. And just a rent growth of 10% could have a huge impact on your property value. And even though an investor might look at that and say, well, I know I can raise rents, whether they will pay you the full amount for something they could do themselves or something that's already done, the differential is usually worth it, because once it's done, it's done. The other thing that this, again, is something that I know you have a lot of experience with, and this is more anecdotal from my end, because it's not necessarily an expense reduction or something that's just quantitative to the valuation. But so often I see folks list properties. They might even know in advance that the roof needs to be replaced, or that there's substantial damage to the siding and it's not, peeling paint and it needs to be painted. And maybe that's their motivation. They don't have any money to bring to the table and they just want it gone. And like you said, sometimes that happens. Sometimes that's the seller's motivation. But if you're looking to get top dollar, what I see happen a lot is that they know these issues are present. They come up either in inspection or during the appraisal. I'm not a building inspector, so it's usually an inspection, but sometimes it comes up in appraisal if there's really significant issues. And then the negotiations start from there. And maybe they agreed to pay this price. Maybe they agreed to pay $1 million for the property and the roof only costs $50,000 to replace, but they want to negotiate $100,000 off because now they have to deal with it. And it's happening. The skeletons came out of the closet afterwards. This is really gets into your arena, but I've seen it happen more often than not, where when that comes out as part of the buyer due diligence and the appraisal process, the deductions are typically far greater than the cost to cure.
Mm-hmm. Yeah, that's well said. I would totally agree with that. And it's funny because sellers just drag their feet, but they wind up giving it up in negotiations, because you're typically at least 10, if not 20 days into having the property pending. So it's off market. Yeah, you could have a backup, but once it goes pending, people stop looking at it. And now you got to decide, do I terminate, put it back on the market, hope I get an offer, or do I negotiate? I typically tell my sellers, negotiate. Let's solve the problem right now with the bird in hand, with the buyer that's in front of us, because they've already made an offer and we know what we have, versus putting it back on the market and waiting to see what comes next for an offer.
Well, and I think that happens 9 times out of 10 because there's that opportunity cost there to the seller. But it's like, if you're aware of it in advance and you had the cash to cure it, you would save yourself that significant discount, making it somebody else's problem. But some people just don't. They just market it as is and they know that's going to happen. But also when you have a situation like that, that can really impact financing ability. Sometimes it has to be a condition of the sale. If you're getting bank financing, you can't just, if they're not coming to the table with cash, they're not going to buy something that has a bunch of peeling paint and rot and a roof that's caving in.
Yeah.
The bank's not going to like that.
Yeah, good point. What are some common mistakes that you see property owners make that has a detrimental effect to their appraisal value?
I think, again, just not raising rents, not managing the property as though it's professionally managed. If you're managing it yourself, you're not dealing with repairs as they come up. You're letting things go for a long time, which ends up costing you more in the end. And again, just having these long-term tenants. I can't tell you how many properties I've appraised where and I think this is great for long-term housing. The tenant's been there for 20 years and they're paying $500 a month, but their unit is just trash. If the owner's going to do that you should at least still do regular inspections and keep the unit updated, so you're not having to completely renovate, or the buyer isn't having to completely renovate when they acquire the property, because it causes problems. Also, It causes moral problems. If you have somebody in there and you have to kick them out to renovate the unit, it's just better to manage your property like you're professionally managing it if you're not going to have a manager. Although I have to say, the properties that are getting the highest rents are professionally managed.
I would totally agree with that. Yeah.
Hire a professional when you need a professional.
Is there any tools that people could use? Is there any trainings that people could do to if they do want to professionally manage it themselves? Is there any trainings or tools they could use to like get better at like what you're talking about?
So the Lane County Rental Owners Association has a lot of trainings. Coming from somebody who we have a few units and we self-manage, and constantly I'm thinking, oh my gosh, we should hire a manager. It's very hard to self-manage. Not only is it hard to not be emotional, but it's hard to make the right financial decisions for yourself and increase rents and put forth that money to repair. It's hard. But the Lane County Rental Owners Association, they have I actually think March 8th, they have, I don't know when this will come out, but they have a full day boot camp, a landlord boot camp. And they offer stuff like that all the time. So you can go in and you can use their resources, you can take their boot camps and become a savvy-ish manager. But I still just don't think anything replaces the professionals, especially in this landscape where the laws are changing so frequently. Mm-hmm. I'm constantly operating in fear of breaking some tenant right.
Oh gosh, that is scary.
Tenant landlord law is so tricky. And I can attest, Zoe, from what you're saying, because I self-managed my own properties for years. And after my husband passed away, I just decided, I want to travel and just have a little more fun in life. Not that he wasn't fun, but, just I wanted to travel. And it's really hard I own some commercial properties as well as residential. And it's really hard if a tenant calls and says, hey, a pipe is broke or my front door lock doesn't work. You better have a good advocate there for you. So I put my properties with a property manager. And I have to honestly tell you, I have kicked myself for the last year. Why didn't I do this 10 years ago? I mean, what a breath of fresh air. Now my tenants just deal with my property manager. That makes them happy. They are very professional and they're happy. I'm happy. It's worth it. And shop around because you can find property managers that'll do it for 6%, 8%, 10%. It all depends on the level of service that you want. And it also depends on if you're a pain in the neck as an investor. They're probably going to charge more. If you're needy and you whine a lot, they're probably going to charge you a little more. So be nice.
The PIA premium.
Yeah. Yeah, that's it. That's
hilarious.
Hey, Zoe, what advice would you give to an investor looking to invest in the Eugene-Springfield multifamily market?
Oh, just blanket advice. Let me think about that.
And advice specific to so a lot of times investors will call me and they're like, hey, I'm interested in buying units. And they're also looking at maybe the Boise market as an example. Well, everybody loves Boise because it's fast growing. They've got lots of jobs there. They're a red state, but they're also at a 4% cap rate. And I'm not sure there's anything on the market. A lot of it sells off market and stuff. So if an investor called you and said, hey, I'm thinking about coming into the Eugene-Springfield market and I want to buy multifamily, what's one thing that you'd give them for advice? Obviously, interview professional property managers like we talked about, but what other advice would you give them about our market?
I think the thing, like we talked about before, the thing that's unique about our market, there's a couple of things. One is that we are a university town, which is helpful. And so an enrollment has finally started growing again in the last couple of years after it had been declining. And so that's a favorable thing about our town. And our established urban growth boundary are very, I'd say, complicated land development process. It's hard to build here and there's not a lot of land. And I think even if you're shopping for a property that's been already improved property, the fundamentals of our area should come into play in terms of your total risk assessment. The fact that we don't have oversupply in a large sense and that we have an established urban growth boundary and a difficult entry process to our new construction, I think that's a favorable thing when you're looking at improved properties, because you're not looking at something where you're going to buy it and then there's going to be so much new construction that all of a sudden your rents go down. Mm-hmm. We saw a very slight downward trend of rents back in 2012, but we didn't see the kind of, rent impacts that some of the bigger overbuilt markets had, even in our last recession. And so I think we are sheltered in a way that some of these bigger markets are not. And again, since I don't keep my finger on the pulse of all these different markets, I don't have a great comparison to specific different market areas. But I would say that the general fundamentals of these markets is critically important when you're investing. Even if you're investing in an old 1960s apartment, you still want to understand the macro risk of what could happen in this community. Are they going to expand the UGB? Is there going to be huge sprawl? Is single family construction going to happen at such a rapid pace that it's going to knock out my multifamily demand? I mean, all of those things come into play. Like I said before, our single family construction has been so low that it has really allowed for this robust multifamily development. And that all plays into your risk profile of your property.
I would totally agree with that. Well, thank you for joining us today. You've been a wealth of information. Hey, I have a favor to ask. Would you be willing to come back and be a guest after you do your fall campus survey next year and kind of get a pulse for the campus market?
Oh, yeah, I would love to. I really wish we could get our manager friend to join collectively. Maybe we can bully her into it. But that's, I think next year will be exceptionally telling. I've been saying that for 4 years, so maybe don't trust me, but I keep saying this year's going to be so telling because I just think the vacancy is going to, this year, 2024-25 season was the first year that I was right. It was like, okay, we actually are seeing some movement here. But now we'll be in 25-26, we'll be coming off the heels of our massive influx of new construction. And so the projects theoretically should largely be stabilized. And I think that's going to tell us a really interesting picture of what's happening on campus. And so I'm excited to do that. And I would love to come talk about it when it's fresh in my mind.
Oh, that'd be awesome. Okay, before we end each session, I always ask Brittany for you to tell me one thing you learned today.
Wow, we went over a lot and I learned so much about like the different topics. I think what I found the most interesting was how you were saying that it's these older single family homes that are like 6-7 bedrooms that are really rising, and then versus these like high luxury apartments, like quad style, close to the campus, those are actually dropping off a bit. So yeah, I just found that really interesting. If I had to guess, I wouldn't have expected that. But also having gone to school and know I lived in 2 different types of places like that, I did find that the privacy was a little bit better in those bigger houses and just you have a little bit more control. So I think that's a really interesting place to keep looking for investors and for people who are maybe redoing some of these units. As you said, maybe all you need to do is like add an extra bathroom into the unit, make sure they have washer dryer, and the parking not being as important there because they've got the street parking. I know I used to take the bus to school. A lot of the schools have like trams that come around. So I think parking for every single student might not be as important. But yeah, I just thought that was really cool, really interesting. Like I wouldn't have guessed that about the student housing market.
Yeah, isn't that interesting, Zoe, like Brittany just said, because remember in the day when parking was instrumental for student housing in the Eugene campus market, and now because it's like everything's parking exempt, it's how many units can I cram within walking distance to the U of O? I think they call it roll out of bed in your pajamas and go to class. I mean, that's kind of what the investors think in their mind is how close can we get to the campus and the kids just roll out of bed and go to class?
Well, and I think that, one of the things that we've always said as appraisers about that parking requirement is people are like, well, what's going to happen with this parking requirement? How's that going to change things? And it was like, well, parking is market driven. You can go ahead and take all the parking away of your suburban apartment complex and just fill the entire site with units. Your rents are going to go down. You're not going to have tenants because in a suburban setting, you have to have parking. With the U of O, it's just a little bit different. If you're it's still nice to have some parking. The market demands a little bit of parking. But if you're on campus within walking distance, there's other places that the students can park their cars for long-term storage. And so you can get away. The market dictates that you can get away with a little less parking. And Brittany, you reminded me, Rene was asking about like investing in our area. And I think something really critical that we're going to see happening over the next few years, or, once people can afford to build, that's interesting about our area. And we won't go down this rabbit hole, but with middle housing and the parking exemption, you now have so much more utility of a big backyard. And
Yeah.
you didn't have that. I mean, you've always been able to expand a little bit, but especially on campus now, if you've got a spot that you can plop another unit or a duplex, and you're not forced now to build a garage or have one space per bedroom, basically, the possibilities have dramatically increased in terms of abilities to build denser developments in small little, 0.08, 0.06 acre yards now. But we just, we're not going to see that really manifest until folks can feasibly build.
Well, Zoe, thank you for being here today. We cannot wait to have you back in the fall after you've done your survey. And we will get our property manager friend to join us because it'd be interesting to hear her perspective on lease ups and what she's seeing as well. So it'll be a happy foursome.
Yeah, I would love to pick her brain on all that.
That's awesome.
Coming up next on Commercial Connections.
The appetite for lending, I kind of equate it to being on a pendulum. Sometimes, like a few years ago, it was on one end of the pendulum. There was a lot of liquidity in the market. Buyers were coming in with a lot of down payment. The economy was going. So banks were lending, and we had money to lend because our deposit base was really high. There was so much stimulus money put into the economy, whether companies were getting PPP money or pandemic money for individuals. Our deposit base was really high, so banks had money to lend out those few years. Now things have changed. People are using their savings, and deposits have depleted at a lot of institutions. And so now they're being very picky at what kind of loans they want to do because we only have so much money to lend out. And now we are going to be picky. For some banks, like you said, Rene, I imagine what you're running up against or hearing is, nope, no new clients. We will do loans, but only for existing clients.